June 2025, Paper 2 Financial Statements. Total mark for this paper is 50. On 31st December 2024, J, a sole trader, provided the following information. Inventory at the start of the year, machinery at the start of the year, discount allowed, discount received, general expense, insurance, machinery repairs, purchases, rent and rates, return inwards, revenue, wages and salaries. Additional information: as of 31st December 2024, closing inventory was valued at $12,900. Machinery is depreciated at 20% per annum on a reducing balance basis. There had been no purchases or disposals of machinery during the year. Irrecoverable debts of $850 were to be written off. Other receivables for insurance were $250. Other payables for wages and salaries were $440. You had been expected to prepare an income statement for the year ended 31st December 2024. First, let's understand the components of an income statement. Remember, the first section of income statement is net revenue, which includes the revenue takeaway sales returns or return inwards. Step 2 is to deduct the cost of sales, and the component of cost of sales: opening inventory plus purchases plus carriage inwards. Deduct drawings. These are goods drawings. Deduct the purchases returns or return outwards. Take away closing inventory. Once that's done, number 3 is add other income. Number 4, deduct the expenses, less expenses. At last, you find profit for the year. Right. So let's finish the first section, which is net revenue. Let's look for revenue in the question. As you can see here, we have the revenue of 143,200, and there is a return inwards of 3,214. There aren't any additional information related to revenue and return inwards. Therefore, we list the return inwards and the revenue, and then we find the final total. So 143,200 is the revenues, return inwards 3,214, which needs to be taken away. Therefore, the net revenue should be 139,986. Now let's figure out the components of cost of sales. We have opening inventory, we have purchases, there aren't any purchase returns, carriage inwards, and then we have closing inventory over here. There aren't any goods drawings. So let's put this in order. So we have opening inventory, we have purchases, and we have closing inventory. Now let's write this in order. As you can see here, we have opening inventory, add, purchases, add, closing inventory, deduct. We enter those figures and then find out the cost of sales. Next step is to figure out the gross profit. So how do we find gross profit? From the revenue, take away the cost of sales. So your revenue is 139,986. Take away 72,020. Therefore, you should get 67,966. Now let's see if we have any other income. We are done with cost of sales now. Let's check if we have any other income. I'll color code them in red. As you can see here, we only have discount received for other income. So let's enter discount received and enter the figure, which is 534. Now add the gross profit with the other income total, which should be 68,500. Now let's complete the expenses section. Let's resolve the additional information before we move into entering the closing balance of expenses. So machinery is depreciated using 20% reducing line method, and there had been no purchases or disposals of machinery. So how do we calculate depreciation for reducing line method? Take the cost, take away the accumulated depreciation, find the net book value, and then calculate the percentage. So we have the cost and the accumulated value over here. So let's calculate it. 75,500, take away 18,750, you get 56,750. Let's calculate 20% of that. Which should be 11,350. Now let's list this under the expenses category. Depreciation, which we calculated right now, is 11,350. Next adjustment, irrecoverable debts 850 were to be written off. So this is a bad debt. So let's enter that in the expenses. One was this figure, and irrecoverable debts 850 written off. This should go under the section of expenses. So let's enter this figure, which is irrecoverable debt, and let's figure out the amount, which is 850, given in the additional information. Next adjustment, other receivables for insurance were 250 and other payables for wages and salaries were 440. Remember, if it's the end of the financial year, any prepaid amount should be deducted and any accrued amount will be added. So let's go to insurance. You have insurance 2080. From this, we take away 250. Therefore, let's find the amount, which is 2080. Take away 250, should give you 1,830. This should be written under expense. So let's list that, which is insurance 1830. Next one, other payables for wages and salaries were 440. Other payables means accrued, owing, which should be added to the wages and salaries, which is 440. Now let's add this, which is 24,560 plus 440 is 25,000. List is under expenses. That is wages and salaries. Additional information are over. Let's see if we have any to be listed under expenses from the list given here. Discount allowed is an expense, general expense is an expense, machinery repairs goes under expense, rent and rates under expense. Now let's list them under the category of expenses. Now we have finalized all the expenses. Let's total up all the expenses. It should be 1328 plus 8,900, add 5,600, add 1,830, add 850, add 11,350, add 1,500, add 25,000. It should be 56,358. Write that within brackets. Now from this figure you take away the expenses. That is 68,500 take away 56,358. That's 12,142. This should be the profit for the year. Right, let's move to the next question. Following the preparation of his income statement, Jay discovered that a payment for machinery repairs 500 had been entered in the machinery account. That means an expense is considered as an asset, right? So how are we going to correct this error? We already figured out the profit for the year, which is 12,142. So we need to reduce the machinery account. We have to reduce the machinery repairs account and add it to the machinery account. So there'll be an adjustment for the depreciation as well. Right? So discovered a payment for machinery repairs 500 had been entered in the machinery account. Now it's important that this should be listed under expenses as 500. And then we need to show the workings over here for the depreciation part. So it's 75,500 was the cost given. 500 was written as a non-current asset. Remove it. Therefore 75,000, and then take away the depreciation 18,750 in order to calculate the depreciation. So let's calculate it. So 75,000 take away 18750, which should be 56,250. Calculate 20% of it. 20%. 11,250. The actual figure should be 11,250, but we entered as 11,350 over here, as you can see. Therefore, now it's important that we need to reduce by 100, because earlier it was 11,350 and now it's 11,250. So from 11,350, now the depreciation amount has reduced to 11,250. Therefore, the expenses should be reduced by 100. Right? Therefore, let's show the working 100. We need to add, deduct 500 because it's an expense. Therefore, what should be the corrected profit? 12,142. Take away 500 and add 100. It should be 11,742. Question C. J is considering changing his method of depreciation to straight line method as he believes that this will increase his profit for the year. As you know, using reducing line method means every financial year the amount of depreciation decreases, reduces. Whereas for straight line method, it's the same amount which will reflect in the following years. Explain referring to a relevant accounting concept whether he should proceed with the proposal. Now, he's planning to change from reducing line to straight line method. Is it viable? Is it doable? So explain this. So this is a sample answer. Let's start with the application, with the knowledge. J should not proceed with the proposal as he will not comply with the consistency concept. So what does consistency concept mean? Which states that one particular method has been chosen by the business must use this from one accounting period to the next. Why they have to do this? This is because this will enable the business to make a meaningful comparison year to year and avoid distorting the profit for the year. Now, every year, if you keep changing the method of depreciation, it can give different, differentiation in the profits that we calculate. So, consistency concept means once you apply a method, you use the same method throughout the upcoming financial years. And if you have given an answer like this, you'll get the full 4 marks. So, the point, state which accounting concept, develop it, and then say why you're doing it. Therefore, what would be the impact? Question D. Advise J why it is important to differentiate between capital expenditure and revenue expenditure. Remember, capital expenditure means it's an investment in buying non-current asset or you're making some changes to the existing non-current asset. Whereas revenue expenditure is when you're spending for the day-to-day expenditure of your business. Right. Now let's look at the sample answer in order to see how you can reach 5 marks. Starting with the knowledge. It is important for J to differentiate between capital and revenue expenditure, as the incorrect treatment of revenue expenditure would result, so let me take that to a development point, would result in profit for the year being overstated or understated. Hope you can remember the example which we did here. The example here, an expenditure was considered as an addition to the non-current asset. So it will eventually have an impact on the profit. That's what it states over there. Similarly, it is the incorrect treatment of capital expenditure would result in the non-current asset section of statement of financial position being overstated or understated. Now, linking back to the example. If, for example, J enters the purchases of a motor vehicle in the motor expenses account, this would result in the profit for the year being understated, and the value of motor vehicles in the statement of financial position being overstated. Part D. Advise J why it is important to differentiate between capital expenditure and revenue expenditure. Remember, capital expenditure means it would eventually increase or decrease the non-current asset, whereas revenue expenditure would increase or decrease the day-to-day expenditure, that means the expenses. It is important for J to differentiate between capital and revenue expenditure. Why? As the incorrect treatment of revenue expenditure would result in the profit for the year being overstated or understated. As you can see in the previous example that we did, your profit for the year is 12,142 initially, and then later, after the adjustment because of the error, it became 11,742. So, it is as the incorrect treatment of revenue expenditure would result in the profit for the year being either overstated or understated. Similarly, the incorrect treatment of capital expenditure would result in the non-current assets section. Where do we enter this? In the statement of financial position being either overstated or understated. As per the example question that we did here, as you can see here, the actual machinery cost should be 75,000. Because of the error, it will be treated as this 75,500. Therefore, in the statement of financial position, the non-current asset section would be overstated. If, for example, J enters the purchases of motor vehicle in the motor expenses account, this would result in the profit for the year being understated. Now, this is your application skill, right? And we had done the accounting treatment as well. Earlier, your profit for the year is 12,142. Now it's 11,742. So it eventually understated the profit. And the value of the motor vehicles in the statement of financial position being understated. Therefore, it is important, treating capital expenditure and revenue expenditure incorrectly would result in the financial statements not providing a true and a fair view of the business. What are the financial statements? One is income statement and the other one is statement of financial position. Victoria and Albert are in partnership, sharing profits and losses equally. Means the profits are shared equally between Victoria and Albert. That is half. Their partnership agreement also provides for interest on capital and interest on drawings at 5% per annum. So, interest on capital, it's 5%, and interest on drawings, it's 5%. A salary of $1,000 per month and for Victoria, and no interest on partnership loans. That means their salaries only for Victoria, that's 1,000 per month times 12, 1,000. On 30th April 2025, they provided the following trial balance after the preparation of the income statement. As you can look at the information, you have allowance for doubtful debts, bank, capital accounts for Victoria and Albert, closing inventory, current account for Victoria and Albert, drawings for Victoria and Albert, fixtures and fittings, cost, provision for depreciation, land and building at valuation, motor vehicles, cost and provision for depreciation, other receivables and other payables, partnership loan, Albert has given to the partnership worth 8,000, petty cash, profit for the year, trade receivables and trade payables. Prepare the appropriation account for the year ended 30th April 2025. You should remember the format of a partnership appropriation account. They add profit for the year, plus interest on drawings, deduct interest on capital, deduct salaries, and then you find the profit shared between the two partners. Here I have taken the examples of partner A and B. Suppose if there was a loan which is given by a partner, and if the partnership is liable to pay a partnership loan, so that interest needs to be calculated and that would be deducted as interest on loan for partner. In this case, the question states there's no interest charged on loan. In that case, you can simply ignore this section. Now we know the format. Now it's time to insert the figures to the format. So first step is to identify the profit for the year. So let's identify the profit for the year. Let's see if it's given in the question. Profit for the year. Let's go back to the question. As you can see here, we have profit for the year worth 80,000. Now let's plug in that to the format, which is worth 80,000. Now the next step in the format is to identify the interest on drawings. Right? So interest on drawings, it clearly states that interest on drawings will be 5% per annum. So let's calculate the interest on drawing as it's stated here. So you have 1,800 into 5% and then 1,200 into 5%. Let's calculate 1,800 into 5% of it will give 90. Whereas 1,200 into 5% is 60. So we had calculated the interest on drawings for Victoria and Albert. Now let's plug in this to the format. For Victoria 90 and then for Albert it's 60. Now let's calculate the interest on capital. It's not given here, so we need to calculate. As you can see here, interest on capital is what we need to find next for Victoria and Albert. So let's calculate 5% interest on capital. So we have the capital account balances here. So 50,000 and then 30,000. Now let's calculate 5% of each. $50,000 into 5% should give 2,500. And then 30,000 into 5% should give 1,500. Now let's plug in these figures to the format. 2,500 and 1,500 interest on capital. It's 2,500 and 1,500. Now the next is to identify the salaries. So in this case, the salary was only for Victoria, which is 12,000. We had already calculated this. Now let's plug in these figures to the format to find the salaries for Victoria. Now let's total the interest on drawings. 90 plus 60 is 150. And then interest on capital, 2,500 plus 1,500 should give 4,000. Now 80,000 plus 1,500, take away 4,000, take away 12,000 should give a figure of residual profit 64,150. Let's cross check. So it's 80,000 plus 150 interest on drawings, take away 4,000 interest on capital, take away the salaries 12,000, which is 64,150. Now let's find the share of profit. As you see here, the share of profit is for Victoria, it's half, and for Albert it's half because they share it equally. So 64,150 divided by 2, which is 32,075. Now let's share it between these two and write the total figure beneath 64,150. So how did we find the share of profit? So we have taken 64,150 into 1 over 2 and then 64,150 into 1 over 2. Part B. Prepare the statement of financial position. Now do remember the format of a statement of financial position. Non-current assets you add, and then current assets you add, and then you find the total assets. The next section is equity and liabilities. First step is to find the equity, followed by that you find any non-current liability. In this case you do not have any. Then you find the current liabilities. Now let's plug in the details from the question. We already had found the profit for the year figures. As you can see here, it comes under the section of equity. So I'm going to take 32,075 over here to the format. Apologies, you have to prepare the current account in order to insert the figures to the statement of financial position. Let's enter the rest of the figures first. Right. So first step is to find the non-current assets. So let's go back and see what are the non-current assets we have as per the question. So there is fixtures and fittings, cost 50,000, provision for depreciation is 10,000, land and building at valuation 100,000, motor vehicles 30,000 cost, provision for depreciation 15,000. So let's plug in these figures to the format. So let's write down the costs. As you can see here, for land and building, we have 100,000. And then fixtures and fittings, 50,000, take away 10,000. Take away 10,000. For land, there isn't any depreciation. And for motor vehicle, it's 30,000, take away 15,000. Now let's find the total. Now let's work on finding the current account balance for Victoria and Albert. There are two ways that we can find the answers for the closing balance of a current account. One way is to format the current account. If not, an alternative method could be the factors that we add: credit balance of a current account opening balance, interest on capital, salaries, profit share, and then deduct any debit balance in the opening balance of a current account, drawings, interest on drawings, loss share. Suppose if you get a positive answer, it's a credit balance. If it's a negative answer, it's a debit balance which needs to be deducted in the SOF. Now let's figure out the opening balance of the current accounts. We have 3,500 and 3,300. 3,500 for Victoria credit, and for Albert it's a debit balance 2,300. So for Victoria on the credit side 3,500, and for Albert on the debit side 2,300. Same way we can apply it over here. For Victoria it's 3,500 which needs to be added, whereas for Albert it's a credit balance of 2,300 which should be deducted. Now we can derive the information from the appropriation account. Interest on drawings, we have for Victoria 90, for Albert 60. So let's post this on the debit side. Interest on drawings 90 for Victoria, 60 for Albert. Next, interest on capital. For Victoria 2,500, Albert 1,500. This should be on the credit side. So interest on capital, Victoria 2,500, Albert 1,500. We can do the same over here. We have entered interest on drawings, which is 90 and 60. Both I'm going to deduct as per this format. And then interest on capital, I'll add 2,500 for Victoria, 1,500 for Albert. Salaries, for Victoria, it's 12,000. So I enter it on the credit side. For Victoria, 12,000. Over here, I add only 12,000 for Victoria. Now the profit shared, 32,075 for Victoria, and for Albert, 32,075. So let's enter that on the credit side of the current account for profit share. Over here, I'll add it as per this format, 32,075, 32,075. Now the leftover, the drawings amounts. So we have drawings 1,800 for Victoria, 1,200 for Albert. Let's enter this on the debit side, 1,800, 1,200 as drawings, and the same amount applies to this format, 1,800 deduct and 1,200 you deducted here. Now let's balance off the current account. Let's complete Victoria first. So it's 3,500 plus 2,500 plus 12,000 plus 32,075 should give 50,075. Let's enter it on the other side, 50,075. From this you take away 1,800, take away 90. Therefore 48,185. This should be the balance carried down. Balance brought down for Victoria, 48,185. Now let's balance Albert, 1,500 plus 32,075 on the credit side, which is 33,575. Same on the debit side, 33,575. From this, take away 2,300, take away 1,200, take away 60. Should give 30,015. Now both have a credit balance, therefore you should enter this information 48,185 and 30,015 for the current account, the SOFP. Now let's see if we get the same amount using the next format. 3,500 plus 2,500, 12,000 plus 32,075. From this you deduct 1,800 and take away 90, which should be 48,185. Since it's a positive figure, we consider it as a credit and add it in the SOFP. Same way, let's do it for Albert. 1,500 plus 32,075, take away 2,300, take away 1,200, take away 60, should give 30,015. Therefore, as you can see here, we're getting the same figure using both the formats. Now we can figure out the total equity, that's adding the capital and the current account. So let's figure out this. 50,000 plus 48,185 should give 98,185. 30,000 plus 30,050 should give an addition of 60,015. Now let's add these two figures and translate to the last column, which is 158,200. Now let's complete the current liabilities section. So partners loan, why we're entering this under current liability? Because the year ends on 30th April 2025, and you can see here the partners loan, this amount you have here. Partners loan, it's repayable within a year. Therefore, we enter this 8,000 under current liability. Let's see what else needs to be entered under current liability. You have a bank credit value of 10,570. So that needs to be entered over here. That's a bank overdraft. And then you have trade payables, which is 12,000. This figure is a current liability, followed by other payables of 650. Now let's enter those figures over here. Now total up the current liability and write it in the next column, next line, 31,220. Now let's add up the total equity 158,200 and total liabilities of 31,220, and you should get an answer of 189,420. As you see here, the total of the assets should be equal to the total of the equity and the liabilities. Victoria and Albert are considering inviting Anne to join the partnership and changing their business structure to a limited liability partnership LLP. Part C, Roman number 1. Explain one advantage to the partnership of forming a limited liability partnership. In this case, it's an explain question, and this is for 2 marks. Give a point and then analyze. As the LLP is considered as a separate legal entity, each partner's liability would be limited to their investment in the partnership. The development, therefore, their personal assets cannot be used to satisfy business debts. So you get 1 mark for the identification and a mark for the development. Roman number 2. Explain one reason why the partnership should account for goodwill when a new partner joins an existing partnership. For 3 marks, so explain one reason, give 1 point and 2 development assets. 3-mark question. So goodwill is an intangible asset which adds value. 1 mark. First development to a partnership. Therefore, when a new partner joins an existing partnership, he will benefit from an inherent value. So you get 1 mark for that. Followed by which will have built up due to the partnership's reputation. So in this case, it's Victoria and Albert, but worked hard to build the reputation. So we had come to the end of this paper. To summarize, this is 2025 June paper. Question 1 was on income statement, followed by some errors, and then an advice question for 5 marks between capital and revenue expenditure difference. Second question is based on partnership. So we prepared a partnership appropriation account, followed by a statement of financial position for partnership, and 2 theory questions on limited liability partnership and the reason for accounting for goodwill.